رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. الحمد لله والصلاة والسلام على رسول النبي الكريم وعلى آله أصحابه أجمعين. Amma ba'ad. Assalamu alaikum everyone for joining us today. Five Digital Institute Islamic Finance welcomes you all. Those who are joining in and listening to me, they are listening me from Turkey. It'd be great for us to know if you type in a chat box from which part of the world you are connected to us. I'm glad to see many of the faces from last class. Welcome back. Those who are new, today's Masterclass series is brought to you by Taif Digital Learning Institute for Islamic Finance. Taif is focusing on enhancing and developing a resource, manpower, and providing digital learning solutions to Islamic banks and Islamic finance institutions. The main objective of Taif is to enlighten the life of the people by offering Islamic finance as an alternative, ethical, and equitable solution to the masses to enhance the knowledge of Islamic finance to every nook and corner of the world by digitalizing it and making it available to all. Our speaker today, a well-known name when it comes to Islamic Fintech, Mufti Faraz Adam, is joining us from UK. We are honored to have him as a Sharia advisor with Taif. He is on a number of global Sharia board in the country and has published over dozens of research papers in the contemporary Islamic finance matters. Today's webinar is the second of a series where we will be covering the particular area in Islamic Fintech, which is alternative financing and crowdfunding. Friends, all of us here today are directly or indirectly connected to finance in our lives. Finance is a broad term that describes activities associated with banking, debit, credit, capital market, money, and investment, to name a few. But today we are gathered here to learn beyond books, and that we have asked our dear Sharia advisor, Mufti Faraz Adam, to be with us and enlighten us with his knowledge in the area of finance. Assalamu alaikum, Shaykh. Thank you very much for joining us today.
Walaikum salam wa rahmatullah. It's a pleasure to join.
Thank you. Shaykh, I would like you to start the class by explaining what is financing.
Sure. Bismillah ar-Rahman ar-Rahim. To understand, before we even enter the discussion of alternative finance, it's very important to just understand what finance is when the word finance is used, and financing is also used. What does it particularly mean? What does it refer to? Only when we understand this can we then understand how alternative finance has come, what the difference is, and why is it that when we say alternative finance, it refers to something quite unique today. Okay, so when we talk about finance as a term is a very broad term. Okay, if you open up any dictionary, you'll see numerous explanations on the word finance, and we hear it all the time. We see it everywhere. Everybody knows finance is something to do with money. We all know that when finance is used, money is involved. Whether you're getting the money or not, there is some money involved. But finance is a broad term. It describes activities associated with banking, credit, capital markets, investments, leveraging, all these different areas the word finance covers. And to make it even simpler, you could say that finance is all about managing money and the process of the flow of funds. That's finance. It's about money management. That's why when we say Islamic finance, what does that mean? It means money management in an Islamic way. That's what Islamic finance is. And that's what the term actually signifies then. That when you talk about Islamic finance, it's all about managing money in a Sharia compliant way. When we talk about conventional finance, it's about the use of money, the deployment of money, the management of money in a conventional way, which would be interest-based, so on and so forth. So that's what finance means. When we talk about financing, okay, as a verb, as a doing thing, And financing is all about providing funds. It's all about providing liquidity, providing cash to businesses, to enterprises, to banks, to individuals. It's all about one party providing funds to another party which needs those funds. So there's always a relationship between a number of people, and one party is the borrower who's in need of finance, and it will be paying on a deferred basis to the lender at a future date. So that's what the act of financing is all about. It's about providing cash and liquidity to somebody who requires it.
Thank you very much, Sheikh, for making us understand what is financing. Now everybody is wondering, what is alternative financing and what is its origin?
So exactly, now we've understood what finance refers to. A new term has been developed in the last decade, which refers to, or which is commonly known as alternative finance. That's the word that's been used and coined for this industry, which is providing, again, finance and funding, but beyond and outside the traditional method. The traditional method has always been, a person who needs finance. Traditionally, what does he do? He'd always go to a bank. That was the place known for providing funds. But then what's happened is, in the last decade, there's been a boom and a rapid growth of financing providers which are beyond banks. Okay, so it will be, when we talk about alternative finance, it will not be a bank providing the finance. It'll be another business, it'll be another company. It's a non-bank funding, usually small to medium enterprises, small to medium organizations, individuals, maybe some group of people, and so on and so forth. So alternative finance refers to a system which is developed whereby financing is issued by non-bank lenders. And within this scope, there are a number of ways which these non-bank lenders can deploy financing. And that's really how it differs from the traditional way, whereby traditionally you would have this bank. Now, alternative finance refers to really this technological based. Remember, that's really key here in understanding that what's a driver for this, what's driving alternative finance is technology, which is allowed to minimize cost, is allowed to open up more avenues and channels. It's allowed to reduce transactional costs. It's increased market efficiency and allowed to connect, you could say, lenders and borrowers together. Whereas through a bank, although a bank uses, a traditional conventional bank would be using the deposits and leveraging those on its asset side, in a alternative finance, what happens is you have a platform, and this platform is connecting investors and borrowers. There's much more transparency. There's much more, you could say, the investors would more likely know who the borrower is. That's the key up here. So you're reducing the intermediate, it's disintermediation. You're reducing the intermediary. It's being fragmented. And so we're removing the intermediary, therefore costs are decreasing. And because of technology, you can now have a seamless experience on a platform and experience receiving and also investing. So you can receive both or experience both sides of the spectrum when it comes to alternative finance.
Thank you very much, Sheikh, for explaining on alternative financing. Now that everybody knows the difference of financing and alternative financing, I would like to know, what are the Sharia concerns with respect to conventional alternative financing?
Okay, no, sure. I mean, just to add, before we move to the Sharia concerns, it's worth just highlighting that why did this come about, right? Because people might be asking the question, why did alternative finance come? What's the key thing? It really all goes back to 2008 when the global financial crisis hit. That's the real driver, right? The global financial crisis, where banks have been increasingly unwilling to finance small businesses. It doesn't make sense for them. It wouldn't make sense for them from a business perspective to give 10,000, 15,000, 20,000 to a business, right? Remember, from a bank's perspective, smaller loans means smaller profits. Okay, so for them, why would they give 20, 30,000 and invest that time and energy providing funds to a small enterprise when they can be, giving loans and lending and doing business with a company who has, a £5 million turnover, right? So clearly for them, it's a business question. That's the first thing. Secondly, after the financial crisis, there has been increased regulation for banks. Banks have been put under the spotlight because banks were, you could say, the epicenter of the global financial crisis, right? The systemic risk that manifested was partly based on banking activities, or you could say mostly based on banking activities, whereby we were getting these collateralized debt obligations. They were being securitized, being traded, insurance, you're insuring these. So it's affected the entire financial services and financial system. And so if banks were the epicenter, the regulatory regime after the global financial crisis came heavy on the banks. And it has really tightened what banks can do and what banks can't do. So therefore, it made complying with regulation more expensive and more time consuming. So that's the second reason why banks therefore have stopped servicing, or were not so interested in servicing, these small businesses. Okay, that it was very time consuming for them. And you could say thirdly, banks, because SMEs who want these kinds of small loans, they are more high risk. They usually have less assets, so the financing is unsecured. When it's unsecured, there's a lack of collateral, and therefore it's higher risk. And it's not in the interest then for a bank to enter such risky business. And so that's the third reason why banks, conventional banks anyway, were not so interested in having customers who are small businesses. And remember, when we talk about alternative financing, it's usually the small to medium enterprises which are going on such platforms and trying to raise finance. And then you could say the fourth reason why alternative finance has grown and has come is because small businesses tend to have weak cash flows. And therefore, it's hard for them to make a case to banks. It's harder. Whereas on a platform, it's easier because the nature of that platform is you're getting a higher return. Remember, when the banks pay very little interest to the depositors. Whereas on a crowdfunding platform or a platform where alternative finance is being arranged, the investors are usually getting much more for their risk that they've entertained. Okay, so it commensurates the return. So that's why you could say alternative finance has grown, and due to businesses having weak cash flows, banks have been unwilling to enter this space. And fifthly, finally, the fifth reason why you could say alternative finance has grown is partly due to these businesses having poor credit histories, where it might be difficult for them to access financing from a bank because of their credit history. It'll be more likely and easier potentially to get financing through these platforms because the investors have that risk appetite, have that risk return profile, and would like that kind of return, would like that kind of investment, and they see it as a different asset class. And so it matches a number of, you could say, investment profiles for many investors. So now, if we go back to your original question is the Sharia concerns. Majority of conventional alternative financing platforms, whether that's, it's crowdfunding, whether it's P2p financing, whether it's, micro lending, whether it's invoice factoring, these are all forms of alternative finance, whether it's venture capital, these are different areas. Many of them, especially in the conventional space anyway. You could say venture capital can be put separate. That has its own kind of dynamics, and equity crowdfunding. For the rest, whether it's micro lending or it's loans, it's P2P lending, invoice factoring, majority of them are purely interest-based transactions. Majority of them, whereby the structure, it's purely a loan that's being issued by the investors. So the investors are actually borrowers coming onto a platform. They are rewarded for their funds that they provided through interest payments plus principal. And that's why it creates a huge Sharia risk to, one is to be an investor on a conventional platform. Secondly, for a borrowing company to go on a conventional platform and raise financing.
Thank you very much, Sheikh, for explaining alternative financing in the light of Sharia. The next question I have is, what is peer-to-peer lending, and are there any Sharia issues with it?
So P2P lending, what's known as peer-to-peer lending, P2P for short, it's also known as crowd lending, and there's many terms. And to be honest, the area of crowdfunding has, depending where you are in the world, so in some places it's called the marketplace. Some places call it crowdfunding, crowd lending, crowd investing. Just depends where you are. So P2P financing or P2P peer-to-peer lending, also known as crowd lending, it's a specific product whereby it's similar to you could say traditional lending services. Very, very similar, whereby borrowers go onto this platform, they access capital, they're required to pay an interest fee for the capital that they've received. And just depending on the type of business it is, the interest differs. The riskier is, the higher the interest, the less risk, the more stable, the lower the interest. So that's what peer-to-peer lending is. It's usually very, very direct source of lending and funding, whereby investors can match borrowers directly, and investors can go and choose on many platforms who they want to lend to. So it's very clear for the investors that who they're selecting. It's not like the bank where you are just dealing with an intermediary. When it comes to P2P lending, it's the investor. He knows exactly who is the beneficiary of his funds. That's the key difference. And that's why the word peer-to-peer is coming in. One peer being the lender, the other peer being the borrower. There's no intermediary in between to screen and separate both parties.
Thank you very much, Sheikh, for telling us about peer-to-peer lending and what is Sharia concerned with the peer-to-peer lending. Our audience would like to know, are there any peer-to-peer lending platforms available?
So when it comes to Sharia compliant peer-to-peer lending, there are a few. I think there's 1, 2 in Dubai, in the Middle East, in the UAE, and there's not so much of a peer-to-peer lending, but you could say more of like a crowdfunding facility in the UK as well. There's potentially a few now which will be coming. So yes, this space is increasing. We are seeing now Sharia compliant facilities coming, and inshallah it looks like more will come very soon, because the regulation is supporting this. There's an appetite for investors. People don't want to put their money no longer in a bank because the return is so low. People are looking to invest, and because crowdfunding platforms have ticket sizes of like £100, £500, £1,000, it allows the everyday, average person to be able to invest. Classically, to have such exposure and such investments, you would need 10,000, 20,000, 30,000 pounds. It was very difficult to access such asset classes. But now, given the technology, given a regulation, given the growth and development of this whole sector in a number of ways, it's allowed and permitted the everyday person with a ticket size of £100, £500 to come invest and also receive some kind of profit from wherever he's investing or higher return.
Thank you very much, Shia. Shia, just now you mentioned a word, crowdfunding. I would like to know, what is crowdfunding? Is it just a jargon used in the industry to modify funding? What is the reality of crowdfunding?
So excellent question. I mean, see, crowdfunding is literally what the word says. It's a crowd who's funding, literally, right? Whereby we are removing, again, remember the whole idea and notion of alternative finance is to remove the traditional intermediary. That's the whole concept. The traditional intermediary being the conventional bank. The idea of alternative finance is financing in an alternative way, which is the removal of the traditional body or intermediary. And so when we talk about crowdfunding, crowdfunding literally means a crowd of people, a group of people, investors, funding an enterprise, funding a project, whatever, a venture, whatever it may be. It's when a number of people come and they can access, they can see online on a platform, they can see a range of options, they can opt to invest their funds in a range of products or projects, and whatever their risk and return profile is, people can choose accordingly. But crowdfunding comes in many sizes and forms. That's the reality. There's not one style of crowdfunding. There's different models that are out there when it comes to crowdfunding. For example, one of the easiest and you could say a very common form of crowdfunding, it is generally used in, you could say, charitable projects. So I know some Sharia compliant ones where Muslims are crowdfunding for, charitable causes, welfare projects, for poor people. So a number of people come together and support one cause. That's a form of crowdfunding, where so many people have come together. They've not gone through a charity or anything traditionally. They've gone directly to the person. The person, he launches a campaign. People see that campaign. They feel that it's a worthy cause to donate to, and so they donate. So the crowd online has all funded this one person. That's one style, which is a donation-based crowdfunding mechanism. It's donation-based is very common in a charitable space. Of course, for the donors, for those who are funding, they receive nothing. It's purely altruistic in nature. It's purely more reward-seeking, more self-fulfillment. It's not so much about gaining equity or gaining a profit. It's very rare. Then you have a second model, which is not so common, but it does exist, is what we call a pre-purchase model. The pre-purchase model is very interesting because what this is, it allows people to sell a product that they have before it's even created. It's similar in Islamic finance. We have a concept called istisna and a concept called salam. So these two were about the idea of entering into a contract before the item is even there or been created. And it's similar in that sense in terms of its concept and philosophy, whereby this pre-purchase crowdfunding model, it allows people to access early finance, which then can be used to develop a product. And therefore, they take orders for this. And of course, that would mean if you have put some money in, you've invested this, you will have entitlement to a product when it's made. So that's the second form of crowdfunding. So that's two. Number three, we could say is more about like a rewards-based crowdfunding, which is also similar to the donation model. But what happens here is the crowd, the platform or the one who is being funded gives rewards to those who have funded them. So you do get a return here, but the return is not so much of profits or equity. It's more about you receiving something, a service or a product as a way of saying thank you to you. So it's a rewards-based crowdfunding. So people are incentivized because sometimes the rewards are really good. People think, you know what, it's a really good reward. It's worth £10,000. Let me just try. Yes, it does create, it's possible that it creates kind of gambling psyche, but it's not purely gambling in the sense that the item is promised to somebody or potentially to everybody depending who it is. And secondly, your money is not used to acquire the asset. If it's used to acquire an asset and only one person gains, that means a number of people are staking their wealth to gain that asset. That would fall under gambling, and that would be not permissible in Sharia. Okay, so that's where the Sharia risk and Sharia concern is for this type of crowdfunding. And then of course you could say the final two is equity crowdfunding and debt crowdfunding. Equity crowdfunding can be for companies, and it can also be in real estate. Both are on the market. Both are very common. What we mean by equity crowdfunding is the investors will come onto the platform. They actually get a share in the company they are investing in. So they actually get an ownership stake in the company. Or it's real estate. So the investors get a share in actual property, and the property is leased, and therefore in this scenario the investors receive a rental return. Whereas in equity crowdfunding, when it's to do with investment and to SMEs and businesses, the investors are rewarded with profit, right? That's the difference. And then finally, it's debt crowdfunding. Debt crowdfunding is what it says, that it's whereby people on this crowdfunding platform, they provide financing through debt, and of course, any return on that is interest and will not be Sharia compliant.
Thank you very much, Sheikh, on explaining crowdfunding in detail and clearing my confusion. I am pretty sure everybody is clear now what is donation-based crowdfunding mechanism, pre-purchase model of crowdfunding, reward-based crowdfunding, equity crowdfunding, and debt crowdfunding. After knowing all this, it leads me to one last question, and that is, are there any Sharia concerns with respect to crowdfunding?
So crowdfunding, as we just went through the list, whenever we look at a crowd fund, what we need to do is we need to look at two things. One is the purpose. What's the purpose of the company seeking finance? What is it doing? Okay, we have to, and therefore any crowdfunding company which comes onto a platform must be screened for Sharia compliance. What's its core business activity? Is it involved in a halal service, or is it involved in an impermissible service? Are its products permissible, or are its products impermissible? That is one screening. What's the objective of the finance? That's the second thing to consider. Why are they gaining this? Are they gaining this financing so they can open up a new restaurant which sells haram food, unlawful food? Are they receiving these funds because they want to use this to invest in a derivative, as an example? Or are they accessing finance to, invest in impermissible, companies? So these are all questions that have to be, questioned and seen and answered. That what is the purpose of the crowdfund? Then secondly, it's the structure of the crowdfund. So one is very recipient specific, which is the company seeking financing. We look at them. What's their business like? Because we don't want a business which is not Sharia compliant coming and raising financing on a platform, because that would mean we are supporting the growth and proliferation of non-compliant activities, right? So we wouldn't want them to come onto a platform and be financed on a Sharia compliant platform. So one, we look at the purpose of the crowdfund, the business of the company, the recipient, and then of course, as I mentioned, it's the objective with the finances. What are they doing with the finances? And then thirdly, what we look at, so the business itself, the purpose of the finance, and number three, which is key, is the structure of the crowdfund. What's the process between investors and borrowers or recipients? What's the relationships? What's the kind of contracts? What's the profit based upon? What's the investment like? Are investors gaining equity? Are they gaining debt? Are they donating? How are the beneficiaries paying? Are they promising to pay upon capital? Are they sharing revenue and profit? Are the investors bearing any risk? Do they lose? All these dynamics and questions and mechanics have to be considered for Sharia certification and Sharia review purposes. So with that kind of backdrop in mind, if we zoom into the actual crowdfunding models, we have the debt-based. Let's start with the donation-based initially. The donation-based is very straightforward. It's generally permissible as long as the person seeking the finance is eligible, right? In Sharia, there's a warning, or we know that begging and asking others is not permissible generally. It's only permissible for those people who are in dire need. And we've been encouraged to work. The Prophet ﷺ, he encouraged us, he told us, "Al-yadul ulya khayru min al-yadi sufla." The upper hand is better than the lower hand, i.e. the one who gives to others is better than the one who's receiving, because one has worked hard to receive those funds. And likewise, there's a number of hadith when it comes to asking others. The Prophet ﷺ, he has addressed these things whereby, and even the scholars therefore after that have addressed or mentioned in a number of rulings that which type of person can go and ask money from others. So this is very important, that any person who goes on to a donation-based crowdfunding, he is sure that he is eligible to go and ask people for money, because it is, in a way, to some degree, a form of begging and asking. Okay, although it's on a digital platform, but those hadiths should always be there in the back of my mind, that am I asking for something that I need or I don't need, and what's the purpose? And of course, and the investors will also see this. So that's when it comes to donation-based crowdfunding. And of course, if the borrower or the recipient clearly expresses something impermissible, he says, for example, I am going to use this money to buy alcohol or whatever, then of course he should not be supported in that, because you're only harming him. You're not doing any favor to him. Alcohol is an abuse of the body, abuse of the mind, abuse of society. So we would not support them in such a scenario. Second type of crowdfunding, which we touched upon, was a pre-purchase model. Okay, a pre-purchase model can be structured in a Sharia compliant way if we adapt the whole structure to form an istisna. It can potentially fall under an istisna, but it just depends what the product is. If it's a service, what it is. It's not so straightforward, but it would need some kind of engineering to ensure it falls within a Sharia compliant model and everything else is valid from a Sharia perspective. Number three, the third type that we touched upon, was the reward-based crowdfunding. Again, I touched upon this. As long as we can ensure gambling is not taking place, and neither the scenario of gambling is being structured, whereby the money is not being used. The money should not be used to buy the reward and give to one participant, meaning everybody has a stake or a chance to gain that. No, it should be that the money is used for the project, and there should be a promise to give to a number of people this, a reward or a particular winner or whatever, depending on a variable that you decide, which is unrelated, unconnected to the funds which have come into the crowdfunding itself, and that could then make it potentially Sharia compliant. But of course, all of this would need, a serious end-to-end review. I'm very reluctant to class any model as Sharia compliant, because I know the technicalities involved and many areas which require a Sharia review before we can ever deem them as Sharia compliant. Now, number four, it comes to equity-based crowdfunding. We talked about two types of equity-based crowdfunding. We talked about that which is equity in a business, in SME, and we talked about equity in real estate. So these two require, especially the business and SME, a Sharia screening, whereby we check exactly what the business is, what its financials like. Has it got too much interest-bearing debt? Is it borrowing? Is it lending on interest? What's its impure income like? So all these things will be questioned, will be reviewed, and to see whether it passes the Sharia screening ratios are out there, like 30%. So a company should not have more than 30% receivables on interest. Neither should be its payables be more than 30%. So neither can a company have its funds or more than 30% of its funds in an interest-bearing account. And also, neither can it be receiving, so that's its funds, and neither can it be receiving more than 30% as well. So that's two things to remember. And then the third thing to remember is a company's impure income. What's impure income like? Is a company receiving more than 5% of impure income? If it is, then it will not be Sharia compliant. So that's very important to look out for when it comes to equity crowdfunding and when it comes to real estate. Of course, real estate is less problematic. I would say the only concern from an IOFI standards perspective would be that if it's a real estate, if it's a commercial building, the services being provided by this company should be Sharia compliant. So I should not get a share in a property whereby the tenant is delivering unlawful services. That should be avoided based on the IOFI Sharia standards. And finally, the debt-based crowdfunding. When it comes to debt-based crowdfunding, the greatest risk and the greatest concern is interest. Very likely, remember, interest is the incentive for debt in a conventional world. No, there's no other incentive in the conventional world if there's no interest. Then it'll be purely altruistic and it'll be a very social thing to do, a very rewarding thing to do. That's why in Islam, loans are more of a social, rewarding, praiseworthy action. It's a very praiseworthy action. In Islam, a loan is a gratuitous contract, meaning it's not a contract where you can monetize and commercialize. That's why interest is not permitted. So therefore, when it comes to donation-based crowdfunding, it's not permissible to have interest. Of course, it'll be not compliant.
Thank you very much, Mufti Faraz, for explaining every question in detail and enlightening us with your knowledge. Time doesn't allow, or else I have a huge list of questions to ask from you. I can see the questions are already lining up from our audience in the Q&A section. So without further ado, I would like to request the brains behind the scene, our CEO and founder of 5 Digital Institute, Muhammad Ziaullah Siddiqui, to join the conversation and take the respective questions from the board. Mr. Ziaullah Siddiqui.